Net income hitting $249.4 million, earnings per share coming in at 65 cents, and a massive adjusted efficiency ratio of 45.2%.
Which is just huge.
Right. Old National Bancorp just dropped their second quarter 2026 earnings report. Management is calling it a record quarter. And for once, the numbers actually seem to back up the PR hype.
Yeah, they really do. I mean, stringing together 7 consecutive quarters of positive operating leverage in today's banking environment is, it's basically unheard of.
Exactly. So that is what we are unpacking in today's deep dive. We are looking under the hood of Old National, which is now officially a top 25 U.S. bank, to see exactly how they are pulling this off. Because a lot of regional banks are just dodging landmines right now.
Absolutely. You've got interest rate chaos, commercial real estate panic, people moving their deposits everywhere. For Old National to post these kinds of compounding returns, there has to be a structural advantage. It's not just a lucky 3 months.
So let's start with the top-line machinery. The metric that really jumps off the page for me is that adjusted efficiency ratio of 45.2%.
Yeah, that is the number to watch.
And just to contextualize that for you listening, think of an efficiency ratio like a bank's fuel economy. It measures how much money they have to spend on, non-interest expenses, things like salaries, real estate, software, just to generate one single dollar of revenue.
Right.
So hitting 45.2% means they are only spending about 45 cents to make a dollar. Why is that specific number turning so many heads in the industry right now?
Well, because your typical regional bank is usually running an efficiency ratio in the high 50s, sometimes even the low 60s.
Oh, wow. So 45 is way ahead of the pack.
Exactly. Hitting 45.2 means your internal operations are nearly frictionless. And the mechanism behind that is the positive operating leverage you mentioned earlier. It is the hardest trick in finance, right? Growing your revenue faster than your expenses.
Because anyone can boost revenue if they just double their marketing budget or hire 1,000 new sales reps.
Yeah, but then your margins collapse. And that's the trap most companies fall into. But if you look at Old National's quarter-over-quarter data, their adjusted non-interest expense only crept up by 2%.
Basically flat.
Basically flat. Meanwhile, their adjusted non-interest income jumped 15%.
That's a massive gap.
It is. They're squeezing significantly more output from the exact same operational machinery. When you manage to hold costs down while the top line expands like that, it creates this compounding effect on the bottom line. Doing that 7 quarters in a row proves it's a discipline, not just, one-time accounting trick.
I want to pause on another metric they highlighted alongside that efficiency ratio. They reported a return on average tangible common equity of 19.8%.
ROTCE, right.
Which I know is one of those dense financial terms that makes people's eyes kind of glaze over. But if I'm understanding the mechanics correctly, this basically measures how much profit the bank generates from the hard physical cash that shareholders have actually invested.
That's a perfect way to look at it.
Because it strips out all the intangible fluff, right? Like goodwill from past mergers.
Exactly. Banks buy other banks all the time. And they usually pay a premium over the actual book value of those banks. That premium gets recorded on the balance sheet as goodwill, which is an intangible asset.
But you can't pay dividends with goodwill.
No, you absolutely cannot. You can't cover bad loans with it either. So tangible common equity strips all that away. It looks purely at the hard capital backing the bank. Generating a 19.8% return on that core capital is just exceptionally strong.
So for every $100 of real net worth on the balance sheet, they made almost $20 of profit in a year.
Right. It's incredibly efficient capital allocation.
Which naturally makes me wonder, if their efficiency is the fuel economy, what is actually powering the engine? At a basic level, a bank manages money coming in through deposits and money going out through loans. And they pushed a ton of money out the door this quarter.
They really did.
Their loan book grew by a straight $1 billion. That's an 8.3% annualized growth rate, bringing total loans to $50.8 billion. And they didn't do this by blasting out auto loans or credit cards.
No, this is heavy commercial lifting. The main drivers of that billion-dollar surge were commercial and industrial loans, so C&I, which grew by $495 million, and commercial real estate added another $342 million.
Now, here is the detail that stopped me in my tracks. The earnings materials point out that 89% of their commercial loan production this quarter was floating rate.
Yeah, that's a key detail.
But in an environment where everybody expects the Fed to eventually cut interest rates, originating loans where the yield floats down with the market seems like a massive risk to their future revenue. I mean, why would they do that? I assume they aren't doing it blindly.
Oh, they absolutely are not. Originating 89% of your commercial loans on a floating rate is actually a highly defensive posture.
Wait, defensive? How so?
Think about the inverse scenario. Say you lock in $1 billion of loans at a fixed 5% rate today, but then inflation suddenly spikes again, and the Federal Reserve has to hike rates.
Okay, yeah.
Your cost to fund those loans goes through the roof. Your margin gets completely crushed because you're earning a fixed 5%, but suddenly you're paying your depositors 6% just to keep their cash.
Ah, so you're bleeding money on the spread.
Exactly. By keeping the loans floating, Old National ensures that if rates stay elevated, or even if they rise, those loans continue to generate high yields. It keeps the asset side of their balance sheet entirely nimble.
Got it. But to fund $50 billion in loans, you have to have the raw material, right? You need deposits. And this is where the numbers almost seem to defy gravity to me.
The deposit numbers are wild.
They really are. Total deposits grew 3.4% annualized to $56.1 billion. But total deposit costs actually fell.
Down 1 basis point.
Right, down to 171 basis points. I know 1 basis point sounds like a rounding error, but in a hyper-competitive banking environment where customers are hunting for, like, 5% yields on high-yield savings accounts, simply going backward by any amount seems impossible. Lowering your deposit costs while growing your deposit base by billions? How does a bank actually pull that off?
You do it by becoming the operational plumbing of your customers' daily lives. You can't just be a place to park cash. We call this a granular deposit franchise. And honestly, it is arguably the most coveted asset in modern banking.
Because it's sticky.
Extremely sticky. The presentation breaks down the anatomy of this deposit base, and it tells a fascinating story. 80% of their accounts have balances under $25,000. The average balance is just around $4,500.
Okay, so this is deeply rooted in retail and small business. This is Main Street money, not Wall Street money.
It's all Main Street, and that is a massive advantage. Compare Old National to a bank that relies on corporate treasurers who park $50 million at a time.
Right, those guys are just rate shopping.
Pure rate chasers. If a rival bank offers them 10 basis points more, they will wire that $50 million out before lunch. There is zero loyalty. But consider an average person with $4,500 in their checking account.
Their paycheck is direct deposited there.
Exactly. Their mortgage auto drafts on the first of the month, their electricity bill, their Netflix subscription, it's all tied to that one specific debit card.
The sheer friction of untangling all of that just to switch banks is agonizing. It is simply not worth the extra $12 a year you might make in interest somewhere else.
It creates extreme stickiness. And the data backs it up. Even when you look at Old National's top 20 clients, those clients only make up 9% of total deposits. And the average tenure of those top clients is 16 years.
Wow. 16 years?
Yeah. Because of that loyalty, 23% of their deposits are completely non-interest bearing.
So roughly a quarter of the money sitting in this bank is costing them literally nothing.
Zero. That massive pool of free funding is the secret mechanism that allows them to fund commercial loans so profitably. That is what drives that 45.2% efficiency ratio.
Okay, but you don't add $1 billion in commercial loans to the books in a single quarter without taking on a significant amount of risk.
Definitely not.
Especially since they reported a record commercial pipeline of $5.6 billion waiting in the wings. A loan only generates revenue if the borrower actually pays it back. So if the deposit base is the fuel and the commercial lending is the engine, we really need to look at the brakes. How is Old National surviving the credit risks that are blowing up other regional banks right now?
Well, management explicitly refers to credit quality as a hallmark of Old National. And you can see why they're confident when you look at the delinquency metrics. Take non-accrual loans, for example.
Those are the loans where the borrower is in enough distress that they've stopped making payments, right?
Right. And the bank can no longer count the interest as income. Those non-accrual loans actually dropped by $50 million quarter over quarter.
Which is a 10% decline. In a macro environment where commercial real estate is practically frozen nationwide, seeing distress actually shrink by 10% is wild.
It really is.
Yeah.
And their net charge-offs, the actual debt they've had to formally write off as uncollectible, sit at just 26 basis points of average loans.
So they're writing off roughly a quarter of a penny for every dollar they lend.
Exactly. And if I'm reading this right, if you exclude PCD loans, that charge-off rate drops even further to 22 basis points.
Okay, but walk us through that. What actually is a PCD loan and why do they exclude it?
PCD stands for Purchased Credit Deteriorated Loans. So when Old National acquires another bank, they inherit that bank's loan portfolio.
Right.
Some of those acquired loans were already known to be risky or distressed before the ink on the merger was even dry. So by separating out the PCD loans, Old National is basically saying to the market, look, the loans our own underwriters originated. Judge us on our own homegrown credit decisions.
Got it. So they're removing the baggage they bought.
Exactly.
Yeah.
And when you do that, their charge-off rate is incredibly low.
Yeah.
And their 30-plus day delinquencies back that up too, sitting at a mere 0.29%.
The immediate distress indicators are practically non-existent. But, bank risk management isn't just about looking at the loans that have already gone sour. It's about how you prepare for the ones that will inevitably go bad tomorrow.
Right, reserving for the future.
Which brings us to the allowance for credit losses, or the ACL. This is the rainy day fund banks have to legally set aside. Old National's ACL stands at $612 million, which is 1.21% of their total loans. But there is a line buried in the model assumptions for that reserve that totally fascinated me.
Oh, the Moody's thing.
Yes. They state their model assumes a 100% weighting to Moody's S2 scenario. Typically, when banks build these reserve models, don't they blend different forecasts, like maybe 40% baseline economy, 30% upside, 30% downside recession?
Yeah, that's standard practice. It smooths out the math.
Right. So when a bank refuses to blend models and puts 100% of its chips on one specific stress test, like Moody's S2, aren't they just daring the economy to prove them wrong?
It's less of a dare and more of a massive flex of balance sheet strength, honestly. When banks use blended models, they rely heavily on what are called qualitative overlays.
Which is just a polite way of saying management is using subjective judgment to tweak the percentages, right?
Exactly. It provides wiggle room, which, can sometimes be used to artificially smooth out earnings. But the Moody's SQ scenario models a defined adverse economic environment. It usually models a mild to moderate recession or stagflation.
Okay.
By anchoring 100% of their reserves to that specific difficult model, management is completely removing the subjectivity. They are telling the market, we aren't fudging the numbers. We picked a harsh stress scenario, and even under those rigorous conditions, we are fully and comfortably reserved with this $612 million.
It eliminates all the smoke and mirrors, which makes that 0.29% delinquency rate look even more impressive because they're heavily reserved for a major storm while currently sailing in totally clear weather.
Exactly.
But this actually leads us to the biggest contradiction in this entire earnings release. The internal machinery is incredibly efficient, the deposit base is sticky, the risk is tightly contained. But a bank isn't just a spreadsheet, right? It is an organization run by people. And despite posting this record quarter, Old National just completely tore up its executive leadership structure.
Yeah, you're referring to the creation of the new operating group.
Yes. They announced that CEO Jim Ryan and COO Tim Burke, along with a subset of the executive leadership team, are forming this specialized operating group. Its mandate is enterprise strategy and alignment and, quote, emerging growth opportunities.
Right.
And they didn't just shuffle existing titles around. They brought 4 entirely new leaders onto the executive team to focus specifically on revenue enablement, commercial banking, and corporate banking. Plus, they moved Rafael Sanchez into a newly created role, Chief Government and Corporate Affairs Officer.
It's a huge shakeup.
It feels like swapping out the suspension on a vehicle while blasting down the highway at 80 miles an hour. Why mess with the formula of a record quarter?
Because they are transitioning from a paved regional road to the high-speed interstate of a top 25 U.S. bank. This entire shakeup is a direct response to the reality of scale. Old National now sits at $74 billion in total assets.
That is massive.
It is. The organizational structure that effectively manages a $30 billion traditional regional bank will completely break down when you try to manage nearly $80 billion.
The distance between the boardroom and the bank teller just becomes too vast.
It becomes a chasm. When you get to this size, if the CEO is bogged down in the daily minutia of running the bank, the long-term strategy stagnates. So by creating this operating group, Jim Ryan is decoupling the day-to-day execution from the enterprise strategy.
Oh, I see.
He is building a dedicated command center for strategy while empowering the new executives to run the actual offense. You look at those new titles, Chief Revenue Enablement Officer, Commercial Banking President. Those are explicitly offensive roles. They're designed to institutionalize growth so it doesn't stall out.
And the decision to elevate Rafael Sanchez to Chief Government Affairs Officer. Why does a Midwest regional bank suddenly need a dedicated diplomat?
Because when you cross into the top 25, the regulatory spotlight gets blindingly bright. Your relationship with Washington, D.C., with state legislatures, with federal regulators, it becomes a critical pillar of your risk management.
You can't just have the legal department do it on the side anymore.
Exactly. You need a dedicated executive to navigate public policy because at $74 billion, regulatory changes can impact your bottom line by hundreds of millions of dollars overnight.
So they are actively building the infrastructure to handle a massive increase in scale. Which brings us to the final piece of this puzzle. What are they actually doing with the cash they are generating right now, and what is their outlook for the rest of 2026?
They've been very aggressive with capital returns.
Yeah, in the second quarter alone, they returned $163 million to shareholders. That breaks down into $163 million to shareholders. That breaks down into $107 million in stock repurchases and $56 million in dividends. It creates a combined payout ratio of 65%.
Which means for every dollar of net income generated, they are handing 65 cents right back to the owners of the company. That is a heavy return of capital.
Now, there are a couple of quirks in the second quarter data we should clarify, just so we are painting a totally accurate picture. They recorded a $13.2 million gain related to a pension plan settlement. But on the exact same token, they took $12.1 million in pre-tax merger-related charges.
Right, so those two items essentially wash each other out, but it's important context.
Definitely. Now, looking at the full year 2026 outlook, management is projecting intense confidence. They upgraded their expectations for end-of-period loans, guiding for 6 to 8% year-over-year growth. They raised their non-interest income expectations to between $515 and $525 million. And there's a specific quote from management in the presentation. They said, "We see more opportunities than headwinds in today's environment."
Which is an incredibly bold statement right now, especially given that many of their peers are actively pulling back, tightening credit standards, and hoarding capital in fear of a recession.
And I actually want to push back on that quote a little bit, or at least analyze the mechanics of it. They say they see more opportunities than headwinds. But when I look at their balance sheet, they have $3.1 billion in net balance sheet hedges, explicitly designed to protect against downside risk if rates fall.
Yeah, they do.
I know an interest rate swap or hedge is basically an insurance policy, so I have to ask, if you are spending capital to insure $3.1 billion against the economy turning against you while anchoring your credit reserves to a stagflation model, does that actually align with the highly optimistic opportunities quote? It feels like a contradiction.
I get why it looks like a contradiction, but it's actually the definition of modern elite bank management. The best leadership teams play heavy offense and heavy defense simultaneously.
Okay, break that down.
The $3.1 billion in hedges, that is pure defense. Through interest rate swaps, they're essentially locking in a floor on their margins. If interest rates suddenly plummet, the insurance pays out, and their net interest margin is completely protected. The 100% weighting to the Moody's S2 scenario, also defense. They are fully reserved for a severe rainy day.
So the defense is fully set. Where is the offense?
The offense is everything else we just talked about. The aggressive stock buybacks, the upgraded commercial loan growth guidance, originating $5.6 billion in new commercial pipelines, hiring a swath of new revenue enablement executives.
Oh, I see.
By aggressively locking in their margin protection on the downside, they have given their commercial lending teams the green light to go out and steal market share from competitors who are too terrified to lend right now.
Wow.
Ultimately, they are positioning themselves to achieve their projected goal, which is greater than 15% earnings per share growth year over year. You do not hit 15% EPS growth purely by keeping the lights off to save money. You have to actively take territory.
They built a concrete floor under the downside so they can safely swing for the fences on the upside.
Exactly.
And that brings us to the final thought I want you listening to chew on today. We've spent this entire deep dive looking at how Old National is executing organically. We talked about their sticky deposits, their finely tuned efficiency ratio, and their fortress-like credit quality. But there is a lingering detail we mentioned briefly just a moment ago.
The merger charges.
Yes. In a quarter defined by organic execution, they quietly recorded $12.1 million in merger-related charges. And they just built a brand new operating group whose explicit mandate includes focusing on, quote, emerging growth opportunities.
It severely raises the question of what their ultimate endgame actually is.
Absolutely. Because the Midwest regional banking sector is rapidly consolidating right now. Mid-sized banks simply cannot survive the regulatory and technological costs of staying small.
They really can't.
So you have to look at the chessboard and wonder, is Old National just building a highly efficient fortress to protect their independence? Or when you combine merger charges with a completely retooled executive team explicitly designed for scale, are they quietly tuning this engine because they are preparing to become the next major acquirer in the Midwest?
Yeah, when a $74 billion bank starts acting like it's preparing for hypergrowth, it is a narrative you want to keep a very close eye on. It suggests the current story is merely a prologue.
It certainly does. Thank you for joining us for this deep dive. Remember, getting past the PR buzzwords and understanding the actual mechanics of these earnings reports is your absolute best shortcut to being truly well-informed as an investor. Keep asking the hard questions and make sure you follow the show for our daily earnings coverage. We'll see you next time.